Welcome to the Women's Connection. I'm Barrie-Louise Switzen, your moderator. The Women's Connection is a program about events shaping women's lives and helping one gain authentic power on a personal or professional level. So won't you stay tuned?
Welcome. Health savings accounts. What are they? Good question. And my guest, JoAnn Laing, is going to help us demystify what a health savings account is. This is something new that just came into existence in 2004. So I would like to welcome Ms. Laing.
Hi,
welcome.
how are you?
What exactly is a health savings account, better known as an HSA?
A health savings account is for you, the consumer, to save money on health care and build retirement savings. You might think of it as a medical IRA.
Well, I love this concept. How do you get started in it?
Well, it's a two-part program.
All right.
The first part is you have to get a high deductible health insurance plan.
All right.
You can go to almost any major carrier and some of the smaller ones as well. And there's a minimum deductible, $1,000 for an individual and $2,000 for a family.
Well, okay, what other criteria do you need? You're saying a high deductible. What's considered a high deductible?
Well, you pay for your medical expenses up to you reaching the deductible, and then you may have some co-insurance. And then once you reach the out-of-pocket maximum, your insurance pays for all your medical expenses. And so a high deductible, think of it as in terms of, say, your homeowners or else your car insurance. If you were to get either one, you wouldn't pay for like a broken window in your house or a flat tire on your car, but you would have like, you know, a policy for $1,000 or $5,000 on either one. And so if something big came along, that's when your policy for your car, your home would come into effect.
All right, before I ask, I have like 50 million questions going here. Can you roll it over, or do you have to use it every year?
That's one of the advantages of this account. It does roll over from year to year. The other consumer-directed plans that other people may be aware of are like flexible spending accounts where you have to use it or lose it.
Right.
Or a health reimbursement account. Many larger companies have those, and that is you have a medical expense and you go to your HR department and say, will you please reimburse me? And that's set up more like a virtual account. But with a HSA, you own and you can control the account, and it's yours from day one. And so if you were to leave your employer, it goes with you. So it's portable. And like you said, if you don't use all your money in the year, it rolls over. So what's really great is the amount of money accumulates from year to year if you don't use that money for medical expenses.
Now, does, like an IRA, you have to withdraw it by the time you're 72 and a half. Do you have to withdraw your money from this HSA by 72 and a half?
No, you don't. You can withdraw it at any time for qualified medical expenses. It's tax-free.
Okay.
And when you reach retirement, age 65, if you're still working, you can continue to contribute to your HSA. But if you when you start taking Medicare, you stop contributing to your HSA, but the money is there for you to use. And if you use it for medical expenses, then it remains tax-free. If you use it for other expenses, it's taxed at an investment income.
Well, when you put the money in, do you get a tax break because you're putting money into the account?
Absolutely. We look at HSAs as like a trifecta of tax savings. Any money that's put in, whether it's by you, a company, or a third party, whoever makes that contribution to the HSA account gets a tax-free contribution. So that's pre-tax dollars go in.
Wow. So let's say you're making $100,000 and you put in $1,000. So you're taxed on $99,000.
Absolutely.
That's marvelous.
And what's great is when people are right at the cusp of a change from like 10% to 15% tax rate, or 15 to 25, or any one of those, you can sometimes get your taxable income below that rate, so your income's taxed at a lower rate.
I know there's a lot of answers here in the Consumer's Guide to Health Savings Accounts that you wrote. And then you also started with the Small Business Guide to HSAs. How did this all come about, or how did you write these books? Let's start there.
My company, Information Strategies, is a marketing information company, and part of the company focuses on the small and medium-sized business market.
All right.
And over the years, they've been hit harder than larger companies with increases in health care insurance. The national average has been about 15% per year since the turn of the century. So for over 5 years, 75% increase.
That's pretty steep.
But for small businesses, some of them get 21% increase, 39% increase. And so many small businesses, in fact 47% of them, can no longer afford health insurance, and so they don't cover their employees.
What if you are self-employed and you're like one person? What do you do?
Well, if you're self-employed, you can get a high deductible health plan.
All right.
And then you can start to contribute, and you can deduct the cost of the contribution. If you have 2 employees and they're on a payroll, depending on how the company is structured, you can take the premium as a business expense. Any contributions to the employees is a business expense, and any contributions made by the employees themselves is in pre-tax dollars.
So it's a win-win for everybody.
Oh, yeah.
All right. But what happens if somebody doesn't have medical insurance and wants to get medical insurance? Is there any words of advice to what they're looking for in a health care plan?
Well, it really depends on the factors of geographic location. It's really big because insurance is regulated by states. Age has effect, gender, sometimes ethnicity, it depends on the state, and certainly health history. And so what you'll be asked to do is to fill out a census form.
A census form?
Yeah.
Okay.
It has about 10 or 12 questions, the ones that are done online. You fill it out, and they will return bids to you that you're able to get a feel for how much it'll cost you.
So you fill out this questionnaire, you get bids, and then you apply and you figure out which ones you want?
Right, based on what level of deductible you have.
Okay.
And what kind of lifetime maximum you want, what kind of hospitalization, if you want co-insurance after you reach your deductible, or you want 100% coverage, or if you'd be willing to pay 10% or 20% to get to the out-of-pocket maximum, which is $5,100 for an individual and $10,000 and $10,200 for a family. And it changes year to year. And so they're indexed annually for inflation. So those numbers are for 2005.
For example, what's happening to me is that my medical health insurance company is no longer going to be covering me for major medical.
Okay.
Apparently they're going out of the state. So what factors should I look for in a new insurance company?
One is that they're going to be around.
All right.
Another is they may give you good rates this year, but what kind of, can you get the rates renewed? Or are they going to jump them up on you? And so you want to check that. You also want to find, like any plan, whether it's a full managed care program like a PPO or a POS or an HMO.
Okay, stop.
It's an alphabet soup.
Right, let's define it.
Okay, traditionally through the 70s, 80s, 90s came into HMOs. There are plans called full managed care programs.
All right.
And those plans are provided by major health carriers, and they're usually administered by the company health HR professionals.
Mm-hmm.
And you may think of an HMO as a plan where you go to the doctor and you pay $10 or $20 copay. Now, the bulk of those plans have been subsidized by the companies for their employees. They may run $7,000, $8,000, $10,000 a year to cover an employee, but what the employee sees on that is their copay.
Oh.
And they might take out a payroll deduction for, in a company for a larger, so you might be hit, $300, $500 for your family contribution per month, but it's less painful. And so the individual doesn't see the total cost of health care. And if they go to a doctor, they might get a statement saying what the procedure was done, but many people just take those statements, they're called EOBs, and they put them in a drawer. So they don't know that the doctor visit here in New York might be $300, $350. In the Midwest, it's closer to $75, but they don't realize the true cost of what a doctor's visit is. And so under these consumer-directed plans, which are the flexible spending account, which is the use it or lose it plan, or the new one, which is the HSA, or the health reimbursement account, they're finding out for the first time what the cost of the care is, and they're just amazed. They're like, wow. And medical care didn't get more expensive overnight. It's just that they never saw the true cost of what was being charged for the services.
Well, I think part of the problem is the fact that so many companies, as you mentioned, are cutting back on their health care, and now it's being given to the employees to take care of. And so they're just waking up to this whole factor.
The hurdle, we're finding the biggest hurdle is first knowing about the awareness, because
Right.
these are only 18 months old. Education, what is this all about? What's my responsibility? What am I supposed to do? How do I find a carrier to cover my hospitalization or major medical? So there's all these questions. So we're finding that the two major sources people get information is online,
And
no
some-
surprise, and
right.
asking friends and family, colleagues, and saying, what are you doing? What's all this about? Who do I talk to? What do I ask? And so people are hungry for information, but this is all so new that they're struggling with it. Great about HSAs because it supplements your retirement savings. Any money you don't use for your health care expenses in the current year rolls over and builds, tax-free. And any interest and income dividends on those monies that are building is also tax-free. And so is it going to replace that Social Security? No. But is it going to supplement it and help you if you start building it earlier in your life cycle? Yes, it certainly will.
What gets reported to the IRS?
Well, that's the individual responsibility, and the IRS is the governing body for this, so the U.S. Treasury. And so they've created a new line on your income tax form. And this past year it was line 28. And if you decide to give details, there's a form 8889 that
Oh
you
my
can
God.
write out the expenses, but it's up to you to keep the receipts and report it on line 28 on your income tax form. That's the 1040 form. Now, the banks, what they usually do is they give you a checking account sometimes, or a debit card, or you can use both.
Oh, interesting.
And so
Okay.
when you go to a doctor, if you decide to pay at the time of service, you just write out a check or use your debit card, or it can be covered by your insurance carrier, and then you get your statement, and then you decide whether you're going to use your HSA funds to cover it, or you can use your post-tax dollars. Because a lot of people are saying, wow, I just want to build up money in my HSA account and not touch it. So they've set aside the funds, and they're keeping it as a tax shelter, and they're using their post-tax dollars. Who can afford to? It's another way to shelter income.
Well, you say people who can afford to. It's like an IRA. You can't afford not to afford it. So even if you put $20 a week in, it makes sense.
That's a good way to look at it. Just put it in when you can afford to, and you really can't afford not to. And they have shown that people at all income levels do benefit, even people who are getting earned income tax credits. Whether they're a single person that's making like $11,500, if they can just put away a couple $100s, they'll get below the level that makes them eligible for an earned income tax credit, and they'll get back more money than they put away. Or even a married couple with 2 kids that are at like the $35,000, $36,000 level, if they can put a couple $100s in to get them below the earned income tax credit level, they can get up to $4,300 back.
Wow.
I know, isn't that great?
That's awesome.
So there's a lot of advantages at all income levels.
That's mind-boggling. Does one set up their account?
Well, that's the second part of the HSA. The first part was the high deductible health policy. Once
Okay.
that's in place, that's your kickoff date. So if you set it up the 15th of July, they'll consider that it goes back to July 1. And so July 1 is when you become eligible. So when they're calculating how much money you can put into account, which you set up through an account custodian, which is usually a bank. It can be a firm, an investment company as well. Anybody that's approved by the IRS.
Would you say like a brokerage account, if you've got one? That would be a separate account.
Yes, it absolutely has to be separate. It can't be commingled with other funds, but you'll go to your financial institution
Okay.
and set up an account. Generally, it's like a current account, like a checking account or a savings account. They call them DDAs, demand deposit accounts, more letters, just what we need. And you'll keep an amount in there so you're liquid. So if you do have medical expenses you do wish to pay for with your HSA funds, they are available.
It's wonderful.
And then they're just starting to get more financial institutions are offering investment options, which is a high demand item for consumers. And so once you reach a certain amount, whether it be $2,000, $3,000, it can be swept into an investment account, and you can invest it into mutual funds,
Wow.
individual stocks, treasuries, bonds. You cannot put it in things like artwork, old coins, wine,
Aw.
but general things where
Something
you can,
liquid.
something liquid, similar to an IRA. And so this is great because people can, depending on their risk and the availability of when they need the funds, they can, put a little bit more at risk if they're, that's their proclivity, and they can make potentially more, but they can also lose it as well.
Well, it sounds like it's great for those who've never had something like this, even though the baby boomers are hitting 60, well, they're hitting 60 and they're going to be hitting 65 very shortly. They still can take advantage of it and put a max of, let's say, $5,000 if they're 60, if they just turned 60, whatever. But this is a real boon for the young people.
For both. I mean, the young people, if you're 25 and you start putting away $1,000 a year, you're going to have more than $250,000 by the time you retire.
That's
just from
incredible.
doing that. But when you're older, you have less time, so they put in a special provision for catch-up.
Oh, really?
Yeah, so 55 plus.
Okay.
This year, it's extra $600, and next year it'll go up to $700, and it'll continue $100 extra a year until in 2009 and beyond. It's $1,000 extra per year, so that'll help people catch up a bit if they have more years. And the amount that they can put in is based on when they put together their high deductible health plan, and so that's the kickoff date. And so if you started it on July 1st, what happens is you're only eligible for half the year to contribute to your HSA account.
Okay, well, let's go back to me for what else is new. I have a high deductible on my account, my medical account.
Okay, when did you start it?
Years ago.
Okay.
Years ago. So I can put in $1,000 a year.
If it's a qualified one, which means it's $1,000, which you have,
Right.
and you don't have any co-pays until after you reach your deductible.
Right, which is a very high
So-
deductible.
Okay, so it's qualified, and that means that you would be good for a whole year. So if you're a single person, this year you'd put the lesser of the deductible if it was $1,000 or $2,650, which is the amount for 2005. So if your deductible was just $1,000, then you could put into your account this year $1,000.
Well, I have a $10,000 deductible. No,
So-
$5,000 deductible.
So then the lesser of the two would be the $2,650. So this year, you could put away for the whole year the $2,650.
Okay.
Which
Can I
is-
make up for any of the other years?
No, unfortunately not.
Oh, wow.
The good news is that you can roll it over for next year. And if you had an MSA account, which was the predecessor,
What's an MSA?
a medical savings account, they set it up.
Didn't know that.
I know, too many letters. They set up medical savings accounts back in '96, and it was
Never heard of this.
kind of a test case for HSAs, and it was set up for self-employed individuals and small businesses. There were only about 250,000 accounts that were set up under that plan between '96 and 2003, the end of 2003. They still exist. They've been grandfathered, and some people have rolled the MSA accounts, which have $15,000, $20,000 in them, into HSAs, or they've kept them as separate accounts, MSAs.
So I can go tomorrow and open up an HSA and put in $2,600.
Yes.
I
But
like that.
You can put in the money any time before the tax filing period. So, which is really great, is you can put it in every week or every other week or once a month periodically, like you
Right.
mentioned earlier. Or if you get a bonus, you can put in money at the end of the year. Or if you find out you have extra cash come the end of March, beginning of April, and tax filing is, you can put money in for the prior year.
I can't see anybody not doing this.
Well,
But you have to know about it to do it.
you absolutely have to know about it, and they're so new. And there was enough to write a book about because there's little angles and things to consider. But the basic is simple. It's there to help you reduce the cost of your health care. Have money there. There's safety nets involved with HSAs. There's the deductible,
Okay.
where you pay the expenses up to your deductible, and then after that, there may or may not be co-insurance, up to get the out-of-pocket maximum. But the most you're ever going to have to pay for a year is $5,100 for this year for an individual and $10,200 for a family. So if you have a bad medical year, a medical catastrophe, whether it's a car accident or you have some kind of disease that comes, that's not going to turn into a financial catastrophe for you and put you into bankruptcy. And so that's one of the features I like best about an HSA account.
What is the maximum contribution I can make this year?
Okay, as you have a $5,000 deductible,
Okay.
it is higher than the maximum allowed for an individual, which is in 2005, $2,650. And so your maximum contribution would be $2,650. If you were over 55,
Yeah.
you would have also a catch-up provision that would be possible for you. Since you're not, you don't get it. But for anybody over 55, it's $600 additional this year.
So it's $3,100 you can put away.
Which is a nice amount to be able to put away tax-free.
That certainly is. What about if somebody's starting out young? What advice would you give them to do?
I would say it's worthwhile because we don't know what's going to happen with Social Security. People no longer or rarely get that gold watch from their company. People change jobs more frequently. And so you can't anticipate that the government or your company is going to take care of your old age for you. So you have to take the responsibility on your shoulders. And even though someone's young, they have to say, okay, if I can put away $1,000 or even $2,000 a year, it may be a little bit more of a hardship, but it will reduce my taxable income. And when I get to reach old age, I will, or even before, that's my money. It's portable, it'll go with me from job to job. And if I should, be out doing some high-risk sport and have an accident, it's there to take care of me. And so it's a type of insurance. It's a safety net.
Sounds good to me. What about families who don't have insurance?
Well, what we're finding is that 1 out of 3 people who are putting together an HSA program, the high deductible health plan and the health savings account, they weren't previously insured, which is great because you'll read about it in the news about 45 million people working uninsured. What are we going to do about them? Well, this is a solution for many because 1 out of 3 people who are signing up for these didn't have insurance, couldn't afford insurance, and now they can. So they don't have to worry about, that medical catastrophe becoming a financial catastrophe.
Well, wait a minute. You said they didn't have insurance.
Right.
But now they have insurance.
Through an HSA program. See, they are able to afford the high deductible health plan.
Okay.
Because before they were working, but they weren't insured because it was just too expensive. Maybe they worked for a small business that no longer could provide insurance to their employees.
All right.
Because a lot of small businesses were hit with annual increases that were just too high. And even though small businesses, and large as well, know that the #1 benefit sought by employees is health care insurance, at some point they said, we just can't stay in business if we continue to offer health care insurance. And so they've stopped offering it. And so those employees that are working become part of the category which is called working uninsured. And
Okay.
So in the United States today, there are 45 million people that are working and uninsured, or their dependents, their family members.
Wow.
I know it's a lot.
That's huge.
It's scary because if something happens to them or one of their family members, they're saying, well, how are we covered? And what happens is if they're in a car accident or something, sometimes they go into bankruptcy to cover their hospital bills.
Wow.
And so this is a solution because now, whether it's the individual themselves or the small business or even a larger business, they can say, okay, maybe we couldn't afford a PPO or an HMO, a full managed care program, to pay that $7,000, $10,000 per employee per year, but we can afford a high deductible health plan to cover them. And so these plans can cost between 10 and 40, 50% less than a full managed care program. And so that makes the insurance affordable at that point.
So let me get this straight in my mind here. I am an employer. I have employees. I can't afford to pay for them, but I can make an insurance plan with a high deductible, let's say $10,000 deductible, so they're insured for major catastrophes. And in the meantime, the individual employee can put away $2,600 a year, anywhere from $1,000 to $2,600 a year.
Right.
Okay.
Which is great.
Yeah, it's fabulous. But there's a lot of self-employed individuals, all right? They're starting up their own business. They can't get health insurance because they have no track record. They don't have, like it takes 3 to 5 years before you turn a profit to make money. What do those individuals do?
Well, some of them go without. They're part of the working uninsured. Other ones, if they've been insured within 12 months, they can get insurance. And because they have that track record, they have that previous insurance. And so they can go out and get a high deductible health policy and be insured. They can also get COBRA, or unemployment insurance. If you had a policy through your previous employer,
Right.
set up with an HSA, you can take those HSA dollars and pay for COBRA, which is great.
But isn't COBRA only for 18 months? All right.
But you can also get, after that, unemployment health insurance to cover for an unemployment period, and so you can cover it that way. If you're a freelancer, you can get the high deductible health policy, and then any contributions you make into the plan is a tax-free contribution. If you have enough money and you can bind together with a couple other individuals and create a payroll, then you can also take it as a business expense.
I don't know where the time went, but this is awesome. And I mean, I'm flabbergasted and I want to hear more. I mean, in the closing moments of the show, what would you like to leave the audience with?
HSAs are brand new. It's worth exploring. Ask your friends, ask your financial advisor, or look online. You may consider going to our website. It's www.hsafinder.com, and there are others as well. The U.S. Treasury, if you go to irs.gov, you have a wealth of information. And why they're good. They'll help you save on health care.
Right.
You become a better consumer because it's your money that you're spending. You'll build retirement savings tax-free.
Triple tax-free if you live in the state of New York.
Puts you in control because it's your money. So it's portable, it moves with you, it's fully vested from day one. And so you decide what's best for you based on where you are in your life and what you want to do.
Wow. JoAnn, I can't tell you how wonderful this has been.
Well, it's nice being here. Thank you.
And I hope you've enjoyed learning about HSAs and starting your own health savings account.